My name's Mark. I'm a loanaholic. What I do in a nutshell is I give people money to buy real estate. Really, really simple. What I find is most people that get into this space, they want to buy real estate, be investors. They're not so much educated on how money works in the sense of what people are looking for from you to give you money to buy stuff that you can't afford with your own funds. So once you figure that out, a lot of things change in your life. In fact, on Wednesday, I was in a meeting, workshop, talk, whatever you want to call it, with Bart Blatstein. Does anyone know who that is? You ever heard of Northern Liberties? He created that neighborhood from scratch. Okay. So 10 years ago, Northern Liberties wasn't a thing. Now it is.
I'm sorry, Mark, I missed his name.
Bart Blatstein,
Okay.
one of the largest developers in the city of Philadelphia. The two things he said you need to be successful, and this is coming from somebody who's a multi-millionaire. You guys might want to take notes on this. He said you need to know construction. So if you don't already know that, he goes, I would recommend taking some construction management classes. And he also said you want to learn financing, how money works in our space, right? Because if you know how to get stuff done and how to fund it, the world is your oyster in this world, okay? In this industry. So I'm going to focus on the money part because that's what I know. I've had a unique perspective in this business. I've only been in the mortgage business for about 4 years, going on 5 years now. And I started off working with a residential mortgage broker, doing loans for people to buy houses to live in mostly. Some of our clients were investors, but most of it was owner-occupied financing, right? As you would imagine, very, very, very paperwork intensive. That's a highly regulated industry nowadays. After the mortgage crash, everybody was, wiped out, or a lot of people were wiped out. People that, thought they had their stuff together got wiped out. And so the government put certain rules in place so that lenders can't be irresponsible anymore, because that's what they were doing before. They were giving people loans that didn't really deserve them. They were getting loans that they couldn't pay back, and then that happened to a bunch of people all at the same time, combined with some other issues in the market that created a lot of problems. That allowed me to kind of see like the side, right? So if somebody's going, hey, I want to buy a house to live in. Has anyone bought a house recently? You have? How much did you put down? I'm in your business just a little bit.
10.
You put down 10%. When you got your mortgage, did you go to a bank? Did you go to a non-bank lender? Did you go to a broker?
Broker.
You went to a broker?
Through a broker.
Nice. And what did the broker say, if you wanted to, what was the maximum leverage you could get? Like how little could you put down if you really wanted to?
10% was the lowest I could put down.
That was the lowest that he said?
Well, it's primary. It's not an investment property.
They held back some keys from you, but we're not going to talk about that. I'll talk to you about that later. I respect it. Right now, assuming you're not using USDA financing or you're not a veteran and you're eligible for VA financing, you can go as little as 3% down on a conventional loan, right? So owner-occupied, that means that they're going to give you 90% of the money, 97% of the money that you need to buy a property. That's like kind of crazy, right? It's like, hey, I want to buy a house for $100,000. I only need $97,000. Obviously, there's some other costs in there, but as far as the actual purchase price of the home, you only need $97,000. And whatever the purchase price actually is, you just multiply those numbers out. So that's a big deal, right? But if someone's going to give you that much leverage, guess how much they want to know about you? Everything, right? Like I have conversations with people when they're getting loans, and it's like some of the most intimate financial conversations they've ever had in their life, because it's usually the biggest purchase you're going to make in your life, right? So people want to get all in it because the lender has to make sure that they are covering their butts because they're giving you the money, and if you don't pay them the money back, guess what? Now they have a property that might be worth X, but you're so leveraged in that, they're probably going to lose some money on that deal, right? Because it's owner-occupied financing. If you're doing non-owner-occupied financing, typically how much would you need to put down? If I was saying, hey, I want to go to a bank and get a loan, but it's going to be a property I'm not going to live in. This is just going to be a rental property. I'm going to have some tenant live in. 20% down, right? Why is that? Correct. If you don't pay the mortgage, what happens? Are you going to be homeless? No. You know, it's going to affect your credit, obviously, because they're going to report that you didn't pay. You know, you're going to lose that income potentially because if the property gets taken back, your tenant's going to move out. They're not going to be paying you the money, but you're not going to be homeless. So the reason why lenders will give you less money for a non-owner occupied property is because you're not living there. It's an investment, right? So if you start, you know, putting these pieces together, you understand how this works, right? Then you can step out of yourself and saying, hey, I want money, to the other side of the table when somebody's saying, hey, I have the money. And you say, hey, I want to think like them, right? Because if you can see through their eyes, you know exactly how to present your information so you can get everything you want. So I'm going to break down a little bit of game for you guys. Couple things I want to cover really quickly though, because I want to make sure that this is a really productive meeting for everyone. And there's going to be questions that a lot of you have, and some people are going to be scared to ask them because they don't want to feel like, oh man, I'm the person that doesn't know what's going on and everybody else does. So I'm going to go around the room and just throw out some stuff for me. I'll take 8 questions that you guys want to get answered. I don't care who starts, go crazy.
Can you pull money out of a retirement vehicle?
Can you pull money out of a retirement vehicle? And I'm assuming you're referring to like a retirement account?
Yeah, IRA, pension.
Okay.
401k.
Good question. Next one.
I'm interested in learning about rent to own.
Rent to own. Next one.
If you're selling a house now, but it might be on the market for a while, could you get like a cash out? Is it worth getting a cash out refi?
So, worth cashing out
On a property that's listed?
a listed property. Next one. I got yours.
The loans for new construction, refi, all bundle up into one for investment properties. Maybe not new construction, rehab.
So rehab loan
Yeah.
and
It's all bundled up together. So rehab loan for an investment property.
how does it work
How
when
does
you're
it
getting a
work?
rehab loan for an investment property?
What is the
Okay,
detail?
rehab loan for an investment property.
Yeah.
That's a really good question. Okay. Horace?
Really, there's interest rates on investment property.
Interest rates on an investment property. Yep.
What are the factors that dictate how much money lender will loan to you?
Yes. Which factors is the lender evaluating? 1, 2, 3, 4, 5, 6. 2 more.
Understanding of agreement. No, yeah, it's
1031
1031 exchange.
exchange.
Understanding pre-qualification by hard money lender.
Pre-qual. That's kind of the same thing. Yeah. Okay. Somebody got someone different?
Mark, and I don't know if this is the proper form, but wholesale, would that be as far as,
Like financing for wholesaling?
yeah.
Okay, how about that? And I'll take one more because I know almost nothing about this. So I'm going to give you all what I got, but I'll take one more.
I guess like financing with a partner, like an investment property.
Nice. So how to structure it when you're financing with an investment partner? Okay. I like these. I like these. And I think if you guys take really good notes, and then we're going to have an opportunity to ask some follow-up questions, and I'm going to cover some stuff that's just like really important that you guys should know. I think we're going to get a lot out of this session, okay? So I'm going to go down this list really quickly because this is like really straightforward stuff for the most part. Can you pull money out of a retirement account when you were buying a property and investing? Is that what you're asking? Yep. All right, so yes, in a word. Most accounts are going to have rules, and that's really easy. Whoever your plan administrator is, you just contact them. If you work for a company and you get W-2 employment or W-2 income, you can usually contact the plan administrator through your HR department and say, hey, I'm interested in buying a piece of property. I want to know what the rules are for early withdrawal from my account. And they have a set of rules. It may be there's a certain penalty. Usually, if it's an owner occupied, you can avoid a lot of that. If it's an investment property, you're probably going to have to absorb some of that. But if you don't have that money any other way, or that penalty is small enough that the cost of getting the money from another source is going to be greater, it still may financially be worth it. Does that make sense?
Do they allow you to pay it back? So if you were to pull the money out, what would you
Yeah, most accounts will have some sort of loan option, but again, that's going to be very specific to the account, who's running it, what the money is invested in. Obviously, because if it's a vehicle that you can't quickly pull the funds out, then you may have to take a loan against it if that's an option. If it's an account where you can liquidate it quickly, then they may just allow you to straight up withdraw the funds. So yeah, I've worked with clients who've done both. They've gotten loans, they pull money out. Generally though, keep this in mind when we talk about getting a loan, right? So if I'm getting a loan from a bank, for example, or even a non-bank lender, and it's conventional financing or it's being underwritten, taking into account a debt to income ratio, right? Is everyone familiar with debt to income, DTI? That's the percentage of monthly debts that you're paying compared to your gross income. For W-2 employees, it's actually a much simpler calculation because it's just like, hey, these are my monthly debts that are reported on my credit, plus whatever my new debt's gonna be, and this is my gross monthly income. If you're a business owner, they're actually looking at the income that you're saying you make after expenses. Now there's some things that you can add back in, and obviously that would require a more intimate conversation about your personal finances, but generally, a business owner who makes $100,000 a year and an employee who makes $100,000 a year aren't going to qualify for the same amount of financing, even if they have the same monthly debts. Why is that? No one knows?
The risk involved with being a business owner, right? Because your income fluctuates.
That's part of it, but that's not the exact reason for straight up and down underwriting purposes. When I'm a business owner, I own a business. Nicole owns a business. I know there's some other people in here that have businesses of their own. Nicole, do you have expenses for your business? Yes. So when you file your taxes, do you say, hey, I made X amount of money and this is all the money I make and that's it? Or do you say, hey, I had X amount of income, but I had these expenses and then this is what I made left over, right? And so if you were going to a bank or a non-bank lender and saying, hey, I want to get a mortgage, they say, well, let's look at your income. You say, oh, hey, you did good last year. You made $300,000. Hey, you had $290,000 in expenses. How much money did you actually make? So are they going to loan you money based on $300,000 in income or $10,000 in income? Right. And so what happens if you don't have that conversation up front with your tax professional, your accountant, whoever you're using, and let them know, hey, I plan on qualifying for financing, and they're trying to limit your tax liability as much as possible, they could leave you in a situation. In addition, if you're pulling money out of a retirement account as a loan, that's now new debt. So when they're calculating your debt to income ratio, they're going to look at the debts that are reporting on your credit. And even if it's not reporting on your credit, because usually I've never actually seen a loan against a retirement account reporting your credit, that's still a debt that needs to be paid back. So when the lender's doing the calculation for underwriting purposes, they're going to say, what's your payment that you're making to pay back this money? Because they want to see where it came from, right? Those funds have to be sourced. Say, oh, I took out a loan against my retirement account. Oh, great, what's your payment back? Oh, it's about $280 a month. Cool, that's like a $280 car payment now on your credit report. So that gets added in. So if that throws off your debt to income ratio and you no longer qualify for that loan, so you got to be careful with that. So that's why, I don't usually jump out and say, oh yeah, just take out a loan, because anytime you're borrowing money, you got to figure out, hey, is this going to be something that's going to affect my ability to qualify for financing for something else down the road, right? That's an easy one. Rent to own, what specific question do you have in relation to rent to own financing?
Well, I have a property with a tenant in it, and I'm
Okay.
going to potentially offer it to her to buy.
Okay.
I'm gonna get rid of it.
And so you want to know what financing options she would have?
Right, like what can I present to her that would actually make sense for both of us?
You could do seller financing. Do you know what I mean by that?
I have to give her some money?
No. You become the bank. So instead of her going to a lender and getting a loan or going to a bank and getting a loan, maybe she can't qualify for conventional financing. I don't know from Adam. But if she can't or she just doesn't want to go through that process, you could say, hey, I'm going to hold the note for this property, but I'm going to sell it to you. And you can get the documents drawn up so that you have a preset price that you're selling the property to her for. She can actually make a down payment to you and then make monthly payments. And then over a period of time, she can pay that off. Obviously,
The title or she is the title?
I mean, there's going to be a deed transfer in her name, but you're holding the note. So if she doesn't pay you, it's really simple. I've also seen it the other way where, there's no transfer of ownership until she pays it off, but that's got to also be something that she's obviously comfortable with, because if I'm giving you a down payment and making payments, what's up? We got to get that transfer. That's just how I'm thinking. But that's definitely an option. Or she could just go the conventional route and, qualify for bank financing or a conventional loan through a non-bank lender. That's obviously always an option. But that would be probably the path of least resistance, and it's going to probably be less expensive for her, and depending on the situation, potentially more financially lucrative for you, because if you don't have a loan on that property, or if you do have a loan on that property and right now your mortgage is being paid by her rents, you could set the payment to still be higher than whatever you're paying for your mortgage. In that situation, obviously, you generally would keep the mortgage in your name, or keep the deed in your name if there's a mortgage being paid. But if you own the property free and clear, it is what it is. So, yeah, those are some options, and we could talk about that more off the grid too, because that's like a deeper conversation. Is it worth cashing out a listed property? This is a very, very, very good question. The challenge with this is most lenders that do cash out refinances, pretty much every lender I've ever dealt with, if you have a property listed for sale, they won't even consider it for a cash out refinance. They're not even going to look at it and take it through underwriting, because they don't want to see that a property is listed for sale that they're giving you a loan on, because that means the loan's not going to perform. You plan on selling the property, right? You're like actively listing it. So what they'll usually say is, hey, if this property is listed for sale, we need you to take this off the market, and we need to see it off the market for 60 days, 90 days. It varies from lender to lender. There are some funders that will give you short-term funds, meaning, a year, 2 years max. And those loans are obviously going to be more expensive. They're typically going to be an interest-only payment. So if you needed to just free up some cash because you knew that, hey, where this property is located, the sales activity, there's just not enough turnover for me to, think that I'm going to be able to move this in the next 30 days, 60 days. So I may be sitting on this property for the next 4 months until it gets sold. But the cash that I have in this property, I need that equity now because I need to deploy it elsewhere. So that's an option, absolutely. But typically you're not going to be able to go and get long-term financing. It just, if the roles were reversed, hey, I'm listing my property for sale, I want to get a 30-year mortgage. Well, you want to give me that money?
Oh, no, I was thinking about the 1 year interest only.
Yeah.
Because I'm eager to finance another deal.
Right.
I don't have money for that other deal, so I'm waiting
Exactly.
for this house. I just put on MLS.
Yeah, that literally happens all the time. That's why that space exists in financing. It's like that middle ground. Like it's not like just free for all personal loan or unsecured loan money. It's secured by real estate, but it's also not that long-term financing where you're going to be paying it back over the next 15, 20, 30 years. So absolutely, that's possible, because typically those lenders are making their money on the upfront anyway. They're going to charge you some points up front, and they would just deduct that from whatever the loan amount is if you were doing a refinance. And then when you pay the loan off is whenever you pay the loan off. They don't care. And if you're talking to the right lender, they shouldn't charge you a prepayment penalty, or there shouldn't be any minimum yield maintenance. That means that the lender's looking to make a certain amount of money off of that loan. So sometimes you'll see like 3 months minimum yield maintenance or 6 months minimum yield maintenance, right? That just means that no matter when you pay this loan off, we need to get 3 months worth of interest, or we need to get 6 months worth of interest. So if I pay the loan off after 2 months, but there's 6 months minimum yield maintenance, I still got to pay 4 months worth of interest when I make that payoff payment, right?
I was gonna ask, is it kind of like, is it similar to a mortgage though, where you would have like a penalty if you do pay it off early?
Well, that's what I'm saying. Prepayment penalty and minimum yield maintenance are essentially the same thing, but not the same thing. So minimum yield maintenance, they're just telling you up front, this is how much money we need to make. Prepayment penalty is usually some sort of step down feature, meaning if I get a loan for 30 years or 20 years and there's a 5-year prepayment penalty, maybe it's 5% in the first year, 4% in the second, 3% in the third, 2% in the fourth, and then the last year of the prepayment penalty is 1%, and then after that it goes away. Meaning if I paid off the second year that I had that loan, whatever the remaining balance is, I got to pay 4% on top of that, right? So it's just two different ways to skin a cat, but it's essentially the same thing. They're taxing you if you're paying the money off earlier because they want to make a certain amount of money off of that loan, right?
Question really fast. With the cash out refi for like a long-term payment, sorry to ask a question, but just thought about it. But with that, like, I'll give you an example. I have a house, I paid 20 for it, and it's worth like 75 now.
Okay.
So I'm interested so that I could just have some cash on hand, potentially doing a refi. But since the house is in my name, typically probably the refi would be in my name as well. But that's not good for me because like I'm self-employed now, so my income has changed from where I used to be when I was like working.
When you had W-2 income.
Yeah.
If you were to go to like a conventional lender, usually for that loan amount, the property's worth $75,000. The ideal lender is going to be like a small community bank or a federal credit union. For them, yeah, that's
High debt to income ratio.
that's going to be ugly. Yeah. So if you go there, I mean, you could still have that conversation, but don't be surprised if they say, yeah, we don't want to do the loan because you don't look, good on paper. You don't have a lot of, income coming in that we can show on paper. And that's what they like to, see. Even if it's a rental property, even if it's bringing in income, that's what they like to see. There's a very, very, very small pool of lenders that will still do that. It's tough because that loan amount. Typically for non-bank lenders, commercial lenders that are doing property loans on properties that are non-owner occupied, they want to see loan amounts of at least $100,000. Worst case scenario, like $75,000. If they're lending you less than that, it's going to either be super expensive, sometimes prohibitively so, but then also sometimes they just won't do the loan. They're like, yeah, this is below our minimum. We're not going to do it.
Even if it's bringing in rental income?
It's not worth it, the money that they have to spend on getting somebody to do the paperwork, right? Because it's like if I do a loan for someone and it's for $100,000, is it any different paperwork than if I do a loan for somebody for $1 million? Same paperwork. How much more money do I make off of the $1 million loan? 10 times as much. So if I have millions and millions of dollars of capital to deploy, do I want to loan it out $1 million at a time or $100,000 at a time or $50,000 at a time? So at some point they got to set a minimum. That's all it is.
What would be better for an investor, like if they have an income property, would it be better for you to tell the banks that you live there or show them some type of revenue coming in? What do the banks frown upon?
I mean, as a licensed loan originator, you tell them the truth. But yeah, like, do people do that? Do people say, hey, I live in this property and they don't actually? Sure. I have a friend that just got an FHA loan on a property he has no plans on ever moving into. But when you sign for that loan, you have to sign an affidavit that says, hey, I'm going to be living in this house within 6 months for an FHA loan, right? I intend to move into this house within 6 months. Now, life situations change. Maybe you got a different job and your office is now in a different location and it's no longer convenient to go to that property. But you don't want to let the property go and lose your equity. So you say, hey, I had to find a tenant to put in this property. That's a plausible excuse. But if you're coming in with no intention of ever living there, generally you want to just go after non-owner occupied financing because for one, you want to kind of reserve your owner occupied financing for a property that you are actually going to live in. Because you're going to put less money down, and generally those properties are going to be a higher price point because you want to get like a nicer property in a nicer area and it has prettier things. So if I have my owner-occupied financing that I'm using already, let's just say for FHA, right? And I use that to buy a single-unit investment property that cost me $100,000. great, I only had to put $3,500 down plus whatever the closing costs were, right? But if now I want to go buy a $300,000 house to live in and I already use my FHA, now depending on where that property is, what my whole financial picture looks like, maybe I can't get away with 3% down on that next property. I got to put 5% or 10% or 20% down, right? Well, yeah, would you rather be putting the 3.5% down on the $300,000 property or the $100,000 property?
So you're saying reserve that bullet till you need it.
Again, that's a more nuanced conversation that we could have off grid, because it's going to be very specific to you and what your investment strategy is and all those other things. But generally, yes, you don't want to use your FHA for a $100,000 property. You don't even necessarily want to use it for a $200,000 property unless it really makes a lot of sense. You know, maybe you're house hacking, right? You're familiar with that term? I'm buying a multi-unit property. I'm going to live in one unit. The other units are going to pay for, you know, my living expenses, or at least offset my monthly mortgage payment. So those are like different things that you can do, and you can kind of work the system. But you have to be careful with that, because it's not just, you know, turn and burn like it was, you know, before the crash. The government's very much on top of that. Like, hey, we want to make sure that you're actually living in this property. When they're underwriting the loan, hey, is it plausible that you're living in this property? I can't buy a house and say, hey, I'm going to be living here and I'm using my FHA, and then I turn around and sell that house, and then I buy a 3-unit property across the street or 2 neighborhoods over. And we're like, well, you went from living in a 2,000 square foot house to now you're buying a 1,800 square foot property and it's got 2 units in it. What's going on here? That doesn't make sense, right? So then they're not going to approve you for the loan anyway. So you got to, those are like different things to think about. I want to keep it rolling though. We're going to go down the list. Worth cashing out a listed property, bam. Rehab loan for an investment property. That's a really good one, right? So for the last year and a half, I've been focusing almost exclusively on working with investors, and I've gotten very intimate with this process, funding rehabbers. So when you're buying a property and it's in as-is condition, meaning it may not be in move-in ready condition, if you were to go to a bank and say, hey, I want to get a loan to buy this, what are the chances that they're going to say, yeah, sure, we want to give you a loan on a property that you can't move into next week? Pretty low, right? The reason is, again, non-owner occupied financing versus owner occupied financing. If the property's market ready, you can live there. They feel a lot better about giving you higher leverage, right? That means less money out of pocket for you. You have more financing options. And if you don't pay them, they can take the property back and sell it to somebody else. But if the property is jacked up, maybe it needs $30,000 worth of work, maybe it needs $50,000 worth of work, maybe it needs $100,000 worth of work, and they take that property back from you, who are they going to sell it to? They can't sell it to the next person who's looking for a place to live. They can only sell it to a small percentage of the population who's other investors who would be interested in getting a property that they have to fix up, right? So you can't typically go to a bank and get funding on that type of property. You can't even go to a non-bank lender that does conventional loans and get that type of funding. But there are people that will give you that money. Write these down. Private lenders, right? Private investor could be somebody who just has a lot of money in an account. They don't know what to do with it. It's not earning them much. You know, I've seen CDs advertising interest rates of like 2% for a 9-month CD. I know that there's one bank, I think it's Fulton, I could be wrong. They like have a billboard off of the highway, and it's like, oh, we're the official bank sponsor of, or banking partner of the 76ers. We're giving you 1.76. Has anyone in this room done any real estate investments in the last year or so? Okay. If someone was to say, hey, I got this great real estate investment opportunity for you, I need you to put up $50,000 and you're going to make 1.76% over the next 6 months, would you sign on board for that? Right. So if you could show somebody how they could get 6% even, would that maybe be worth it for them instead of putting it into that 9-month CD? Probably, right? So private investors, private lenders, there's always going to be an option for that, to get those types of deals funded. Another opportunity would be going to a bank or going to a non-bank lender and getting unsecured funds, right? And those unsecured funds could be a personal loan, it could be a business loan, Obviously, credit cards. You know, you can get busy with those, do a cash advance off of a credit card. I've seen plenty of investors do that. You also have a bucket of money called what I like to call big dumb money. That's institutional money, right? So institutional money, those are typically funds that are coming from investment funds, right? It could be attached to a hedge fund of some sort. I've seen those. It could be literally a large bank that sets aside a tranche of money and they say, hey, we want this money to perform aggressively for us at a higher rate of return than we would get for doing conventional loans. And then they give it to another entity and they have them lend it out. And maybe they're paying them 6% on that money, right? And then the private company, they charge 8% or 9% or 10%. They keep the spread and then they give that bank their 6% and the bank's happy, right? I've seen that. I actually work with some of those lenders. And then obviously, you know, you could just ask people you know and raise money privately. That's a whole nother monster and you got to be careful with that. But that's an option too. There's people in the group that have done that. So if you're looking to get rehab loans, all it is essentially, bless you, you're getting the money to buy a property, potentially also pay for the rehab, and you have an exit strategy, you better. So your exit strategy could be, I'm gonna sell this property to a retail buyer, and because I've done a forced appreciation, right, a value add, I bought the property for $50,000. I did $40,000 worth of work to it. Now the property's worth $130,000 on the retail market, right? I keep that profit. There's obviously a gap in between what I put into that property and what it's worth now to a retail buyer. So I keep that profit. You could also buy the property, fix it up, and then now it's rent ready. You put a tenant in place, they're generating monthly cash flow for you, and either you just keep your money sitting in there and you're rocking and rolling, or you could pull your cash back out that you invested in that property by doing a refinance, right? That's what some people in this room are doing. You hear that term BRRRR, right? Buy, rehab, rent, refinance, repeat. So if someone's doing a BRRRR or if someone's doing a fix and flip, you know, they plan on flipping it to a retail buyer, there's a lot of people that would give you money for that process because they know that it's profitable, right? But there's a way to evaluate that. So this is actually a point I want to expand on a lot. Has anyone heard of the 65% rule, 70% rule when it comes to real estate investing, right? If you're looking at a property and evaluating whether or not it's going to make sense as a value add, you want to see whether or not it obeys the 65% rule or whether it obeys the 70% rule. Meaning your cost all in to buy the property and fix it up, and ideally even your holding cost of whatever that's going to be, if you're paying someone else for the money to get it done, or even if you were using your own funds, but you were maybe pulling some money from some other places and you had to pay interest payments on it, you want to make sure that that's not more than 65, 70% of what the property's after repair value is, right? Or as completed value or fair market value once it's all fixed up. Why is that? Anybody?
Return on investment.
That actually could be part of it if your exit strategy was to refinance it. From just not even getting that deep, why would you not want to be spending more than 65 or 70% of what a property is going to be worth to get it fixed up and get it done?
It gives you some cushion room just in case the property can depreciate in value. It could, the return on investment, you want to make sure, you need cushion room.
What was that second thing you said? The return on?
Investment,
Right.
yeah.
Is it fair to say that our time is worth money? Right? If you work for a living, your time's worth money. So if I spend 6 months buying a property, fixing it up, getting it rented, or buying a property, fixing it up, and getting it sold to someone, would I want to make some profit in there? If I'm taking money from other areas of my life or money that I had sitting in an account, and it could have been earning me 1.67 or 76%, I want to make sure that that money's making me some money, right? So you got to give yourself enough cushion in there to make some profits, right? And then, as Stephanie said, you want to make sure that you have a nice cushion, because even if you were okay with 15% or 20% returns on your money, you want to give yourself enough cushion that, hey, maybe you had some overages on the rehab budget. Maybe there were some structural issues that you didn't spot. Maybe there was some termite damage that your inspector didn't see when they went through the first time, and the in-buyer's inspector did see it, and so you had to open the walls back up and get the termite damage treated. I've had that happen to one of my friends, right? That's not a fun scenario, but if you gave yourself enough cushion in there, you could still absorb that hit. If you were like, hey, I'm gonna maybe make 10% on this when it's all said and done, hey, bye, bye profit margin. I just broke even on this project. It took me 6 months to do it. It was time that I took away from my business or from my job that I could have been putting in overtime or working on a special project and getting paid more money, and I didn't make any money after this whole 6-month ordeal. So you gotta make sure that you leave yourself room in there, right? And obviously, if you're borrowing the money from someone, do they want to see that you're not making money on a deal, that you're going to be borrowing money from them, and the only way that you're going to be able to pay them back is if you could sell the property for a profit? I'm not giving you that money because it's still a risk tolerance, right? We're talking about an investment property. Is that more or less risky than owner-occupied? More risky, right? Now we're talking about an investment property that no one can even live in until you do some work to it. Is that more or less risky than a property that's rent ready? More risky, right? So you're stacking high up on the risk factors, you got to balance that out somehow. They got to see, hey, you know what? Even if everything goes to heck and you don't pay us this money back and we have to take this property back, we can turn around and sell this to another investor, even if we have to sell it at a discount of what you bought it, and we'll still be able to get whole. So that's how you have to evaluate things, right? The property stabilized, okay? Does everyone follow what Horace is talking about? So we got two different scenarios, right? If someone's getting financing for buying a property and fixing it up, or maybe you already own a property and you're just getting financing for the repairs, right? What's the interest rate look like for that? And then what would be the interest rate on the back end? So on the upfront, it's literally whatever you can qualify for. So what's probably the cheapest money that somebody could get? And I'm going to ask Stephanie because I'm almost positive you did this. What's the cheapest money that you could get in real estate just in general?
I did 2 ways. The rate recently is I got qualified for 9.9%, and that's through private lending. I went through a broker and I do.
Way cheaper than that. What's way cheaper than that?
I got like 5% or 4 or 5% because I took a home equity out of my.
There it is.
My first house.
There it is. So if you were to get a home equity line of credit for a property that you're living in and it has some equity built up because you paid it down, or maybe you inherited the property and it's worth X amount, but you have no mortgage in place on it, that's typically going to be the least expensive money that you can get, right? But that's a bank product, which means lots of rules. They want to know all your personal business, right? They want to see that you have stable income and you're going to be able to pay them back because they want to make sure that you have a plan to pay them this money back no matter what, right? But they're going to give you a much lower interest rate because that's a very stable investment for them.
But that's typically when it's your personal, right?
Correct.
So you can't go, because I need to know this too going forward, because just like he said, there's phases. First you got the, rehab, and then after that you want to do the refi if you want to rent. So me, I started an LLC, so now everything's going to be going underneath my business side of things. So typically probably
It's a different monster.
faster,
Right.
More.
It's going to be higher. Absolutely. So to answer your question, you could get as low as 4-5% if you got a refinance or you got a loan out on a property that you already own. If you got somebody to give you money and they said, hey, I got this in my CD, it's paying me 1.76%. If I pull it out of there and I loan it to you, Horace, how much will you pay me? I give you 6%. Okay, that's 3 times what I'm getting in my CD. Deal. Great. If you came to somebody like me and said, hey, Marc, I want to get financing, either through a private investor or through institutional investor that's going to give me short-term money, so that's usually a 12-month term, maybe even as short as like a 6-month term, at longest maybe 18 to 24 months, those monies are usually going to be like 9 to 12% interest only. If somebody's charging you more than 12% for a short-term money like that, you should probably have already talked to me, but you should definitely talk to me. Because it's not necessary at this point, right? Like there's so much investment in real estate. There's so many people that are making money. There's so many profitable deals out there. Investors have to be more competitive with the terms that they're offering, but then also you as a borrower and an investor, you have to make sure that you have a deal that makes sense, right? They want to see that that deal is going to be profitable. Because if it's not profitable for you, the chances of you being able to pay them their money back gets slimmer and slimmer. And then now, a loan that's already inherently very risky is getting even riskier. Hey, what's your exit strategy? I don't know, I don't have one. Great, let me know how that works out for you. Good luck, peace and blessings, right? So to answer your question, the first part, it just depends, right? It depends on where you get the money from. Now on the back end, if you've already got a property that you've bought, fixed up, it's bringing in income, it's market ready, whatever you want to call it, and somebody can move in there tomorrow, you can show me a lease, you can go to PFCU and probably get like mid-fives right now. American Heritage probably get mid-fives right now. First Trust, who else does those loans? TrueMark, I think, is doing those.
Is that on your name, or could that be a business?
Most of the people that I know that are getting those loans, they're getting them under an entity because they're doing their investing under an entity, but I'm assuming you could do it in your name. Yeah.
Wait, you said you go to TrueMark or?
American Heritage, TrueMark, PFCU, they're hyper aggressive right now because keep in mind with a credit union, they don't have boatloads of money, right? Their money is from their members, and their members are usually going to be within the geographic region. So the safest investments for them are, if it's a property that we can drive to and touch. So they're not going to do a loan in California, Wells Fargo will because they're everywhere. But Philadelphia Federal Credit Union is going to do a loan like in Bucks County maybe,
Right.
you know.
You said they will do it in an LLC.
Yeah, I've seen that. I don't see any reason why they wouldn't.
So is it important to start building, like, because I've gone through credit unions, I have a loan with a lot of loans with credit union. And is it important to build, for me, is it important for anybody else who's in the same situation, is it important to build a relationship now? Because I know that
Yes.
I first
Yes.
got denied.
Yes,
you
yes,
know,
yes,
because I
yes,
didn't have a
yes.
relationship.
Yes, you want to be best friends with your money person.
Okay.
Like my clients that do the most deals, they talk to me all the time. Before they make a move, they're like, hey Mark, I'm thinking about doing this. Do you think this is a good idea? Like, yeah, you want to be very intimately friendly, go over their house, take them out for drinks, whatever. You want to be best buddies with the person that's giving you the money because you need to make sure that they have confidence in you, and then you also need to know how their brain works, right? So if you're talking about somebody who works for an institution, you want to know what their guidelines are. But do you have time to sit down and study that for a week? Maybe not. But you have a lot of conversations with them. You hang out. You guys are just busting it up. This is what they do for a living, so it comes naturally to them. You want to be very in tune on what's going on. Plus, lenders change their rules all the time, right? Especially in non-owner occupied financing. Owner occupied financing, very different bag, right? Because to a degree, those rules don't come from them. Like if I'm doing loans as an institution, as a bank or a non-bank lender, and those loans are going to be resold to Fannie or Freddie, I still have to do it to Fannie or Freddie's rules to a degree. Now I can add my own rules on top of that, but I'm starting with their rules as a base. So I can't just come out and say, hey, I'm changing everything around and we're doing all new different stuff. No, it's like, hey, we got these rules, we got to use these rules, and then maybe we can add our rules in, or maybe we don't add any rules. I don't know. But that's very regulated. For non-owner occupied financing, it's whatever investors will tolerate, whatever our borrowers will, whatever the market will tolerate. And if we can justify it to our investors that we're getting our money from, or to our board, or whoever's setting policy, it's a go. So typically for my non-bank lenders, I get emails from them maybe once a month or once every other month, like, hey, guidelines changed, this is what's going on. That's why it's always good to have somebody like me in your phone. Say, hey, Mark, what's going on? What are my options? What could I really be doing? Cheapest money is usually always going to be a bank, but a bank is also going to be the most rules typically. So you got to look really pretty on paper. You got to make sure that you got your financial house in order, taxes filed, you're showing the right amount of income, all that fun stuff. The most expensive money is typically going to be a private lender or a non-bank lender who just specializes on non-owner occupied financing. But they're also going to have the least amount of rules. Like they have like 8 rules. As long as you abide by those 8 rules, they'll give you as much money as you want. That makes sense because they're looking at asset-based lending. They want to see that the asset that they're lending on makes sense as an investment for them. They want to see that you make sense, right? And you have the assets to get through the process and pay them their money back. And as long as you can show that, they're happy, right? Does that give you a little bit of clarity? All right. I know somebody raised their hand. I'm gonna get to you, I promise. I'm just want to run through these. Which factors is the lender evaluating? This is definitely a time when you guys want to make a list if you don't already have one going. What factors am I evaluating if somebody's coming to me to get a hard money loan? First thing, is it a good deal? How do we determine whether or not it's a good deal, Jabbar?
ARV, if we're under the 65.65%.
Okay.
And the repairs, how much is the repair cost?
Right. It's that simple.
What was the last one?
The repairs.
How much
What,
does the repair cost?
right. So what is it going to be worth? What's the after repair value? What's the fair market value once this property's been fixed up? What am I buying it for? And what are the true costs of the repairs? Not the cheapest number that I got because I went to, Bobo, the contractor that doesn't have a license. Like, what's the true cost of the repairs going to be? How much is it going to be for me to get these permits pulled if I need to pull permits? How much is it going to be for me to get this work done to bring this property up to where it needs to be? Especially if you plan on selling it, because if you plan on selling it, you have to make sure that the property is going to be in a condition that a retail buyer is going to walk through and say, hey, I saw 8 houses today. I like this one the best. I want to get this one.
How about the amount? I mean, they probably won't, even if all you match all the criteria, let's say that ARV is $1 million. Of course, they're gonna evaluate how much you have in the bank as well. So how does that factor in?
Yes and no. So they're going to look at your assets. They're also going to look at your experience. They're also going to look at the timeline and the feasibility. They're going to look at sold comps. So if a property is in a neighborhood where there's been absolutely zero sales activity for the last 12 months, is that going to make the lender feel good or not so good? It depends, right? Maybe it means that there's not a lot of inventory available. Maybe it means that there's been 10 properties listed and none of them have sold. Those are two very different things, right? So that's a more nuanced conversation too. And that's when it helps to have options. So here in Philly, there's lenders that only lend in Philly. And that's all they do. They stick to Philly, maybe South Jersey, maybe they'll go outside to the counties, but that's it. They're not lending out in, Pittsburgh or even Harrisburg. They're just southeastern PA, South Jersey, that's their place. They don't go anywhere else. The reason is because they probably either personally have investments in those areas or they have somebody that they know they can send out to those properties and verify the values, or they just know because they've done a lot of loans in those areas so they feel really comfortable lending there, right? Whereas you may have another lender that they're doing these types of loans all over the country and they'll lend anywhere where the comps exist. So as long as the numbers make sense, they're good. And the way that they verify that is by getting after repair appraisal done to the property. So they're going to do what's called a subject to appraisal, right? So when you buy a house to live in or an investment property or whatever else, and you're going to get money to buy it, the person that's lending you the money is generally going to want to verify that the property is worth what you're buying it for. Is that fair? Hey, I'm buying this house for $200,000, Mark. I need the money. Okay, let me see proof that the property is worth $200,000. So we have a third party go out there and perform a valuation on that property. That's an appraiser. So if the property's in as-is condition, meaning you can move right in tomorrow and everything's good, it's in good working order, then they're just evaluating it based on its current condition compared to other properties that have sold in the area within like the last 6 months. If the property needs a lot of work, maybe it's got water damage, the paint's peeling, it's got a lot going on, they may say, hey, we got to get a scope of work put together. Does everyone know what that is? A scope of work, a rehab budget? That's what are you doing to this property to make sure that it looks like the other properties that are selling in this area. So they want to see a copy of that scope of work. They're going to give that to the appraiser, have the appraiser go out to the property, and then they're going to add all that up. They're going to say, hey, the property looks like this right now, but if you did X, Y, and Z to it, and based on the properties that have sold in the area in the last 6 months, we think it's going to be worth this. So that after repair value, that's subject to appraisal, that's going to determine how much money they're going to give you. So if you said, hey, I'm going to buy this property, I'm going to spend $150,000 on it, it's going to be worth $200,000, and then the appraiser goes out there and they do the valuation, they say, hey, based on the numbers that we're seeing in this neighborhood, this property is going to be worth about $150,000 when it's all said and done. Are they going to give you that loan? Probably not, unless they're crazy, right? Or they may give you the loan, but they say, hey, you're buying it for 100, you're putting 50 into it. We can't loan you based on those numbers. we can loan you, maybe 65% of what the property is going to be worth when it's all said and done. So we're not going to give you all of that. That would be what? 97.5, right? We'll give you 97,500. You got to figure out the rest because we're not going to lend you that part. But a lot of times, if the numbers are that far off, lenders are going to be like, you don't even know what you're doing. I don't want to give you the money anyway. Because think about it, like I thought it was going to be worth 150 or worth 200. It's actually going to be worth 150. That's a $50,000 gap. That's like all your profit that you were planning on making plus some. So yeah, you're not good at evaluating deals. We don't want to give you our money to figure it out. And that's another factor that I was talking about, the experience, right? So most private lenders, if they're smart, are not giving loans to people that are doing this for the first time. Like even your family, unless they really, really know you or they, have undying faith in your competence, they're not going to say, hey, you never done this before? Here's $20,000 for me to go figure it out. So typically, you come to somebody like me because my funders don't care. They look at the deal. Does the deal make sense? Somebody's got over 600 credit score. We'll give them 85% of the purchase and rehab costs, not to exceed 65% of what the property is going to be worth once it's fixed up. To qualify for that, you need to show that you have the assets to close, 6 months of interest-only payments, and 10% of the rehab budget. That's not a lot of money. The hard and fast rule that I tell people is you want to have between 30 and 35% of the liquid assets that you would need to do the project if you had it all cash. So if it was a $150,000 property, then I'd better have 30% of that or 35% of that. Otherwise, why were you trying to do that deal in the first place? You maybe need to go get a money partner, right? No worries. If you're going to be getting money from somebody to buy a property and fix it up, but you don't have all of the money, you should probably have at the very least 30%. I'd say 35% would be a really comfortable number so that you can get through that process. Because what happens when I take out a hard money loan, right? Or a fix and flip loan? I gotta put some money down, right? I gotta have some skin in the game. And then are they gonna just cut me a check or wire me the money all at closing? Hey, I'm buying a property, it's gonna be a $150,000 project. We're giving you 85% financing. That comes out to 42.5, 12, oh goodness, 127, I think 127.5, somewhere around there. We're gonna give you $128,000. Here you go, wire the money. You're buying it for $100,000. You still need to do work to it. No, we're not gonna give you all that money. So what happens is you get advanced part of that money. There's an initial draw. The initial draw is gonna go towards the purchase price. And then there's gonna be rehab draws. Those monies are set aside in escrow, and then as you complete the work, they reimburse you, right? You do some of the work, they reimburse you. You do some more of the work, they reimburse you. You do the rest of the work, they reimburse you. Now, you're not getting ahead of the money that they give you, right? Because otherwise, we're talking about a very risky loan, and we just gave you more money than what you bought the house for. What if you say, hey, this is an investment property anyway, I'm not gonna be homeless, I don't wanna pay you the money, I'm out, thanks. You don't do any work. So you bought the property, you take the difference, and you just peace out. Now, obviously, you hopefully don't wanna do that, but that's how a lender has to think. They have to think worst case scenario, right? Like an underwriter's job is to look at what's the worst thing that could happen. If this person had poor intentions or they didn't know what they were doing or everything went to heck, what's the worst thing that could happen? That's the worst thing that could happen. So are we gonna give you all this money up front? Heck no, right? So those are all the things that are moving around. So do you have the assets to get this done? Are you gonna have enough money to pay your contractor for materials and labor as you're going through the rehab draw process? If you close on the property and you only have $2,000 in the bank and you're doing $40,000 worth of work to the property, how are you gonna get your contractor the materials that they need? How are you gonna pay for the labor? You can't. So most funders, if you have no experience, they wanna see that you have a certain amount of money in the bank so that you can get through that process. If you don't, they're not gonna feel really good about doing that, which I can loop in financing with a partner. That's when you get a money partner. Hey, I need $80,000 to get this project done, but it's gonna be a $200,000 project, but I only have $30,000. Do you have $50,000? Just say yes. You have $50,000? All right, so look, I know what I'm doing. I've been doing this for a while. I've done like 15 rehabs in the last 2 years. You know, this is a profitable deal. If you come in on this deal with me, I'll give you 50% of the profits, and you don't really have to do much. Are you interested? Say yes. Yeah. Okay. Right? Hey, we just got a partnership. Let's make some money together. So now, when you're going to present your package to the lender, you say, hey, I don't have $30,000. We have $80,000. So we're going to be to get through this process. I have experience. We have the money. Our entity has these assets. Let's get busy. Now the lender's like, oh, okay. And there's some other idiosyncrasies. Maybe they say, well, hey, what's your credit look like, Mark? My credit's okay. What's her credit look like? She's got an 800. She's got W-2 employment. She makes $200,000 a year. Very low debt. Okay, great. Great, yeah. Have you both signed for this loan? If you don't pay us back, it's going on both of your credits. What are the chances that loan's going to get paid back? Much higher, right? Compared to like me, okay credit, I don't have enough money to get through the project by myself. Ooh, nah, sorry. So that's how you get around that, right? What else? Listen, that's one of the reasons why you want to be in these types of rooms, right? Like-minded people, you'd be surprised what resources people have and they didn't even know, right?